Hello, finance experts. My name is Alex Gondolfi, and today we'll be predicting earnings by running some correlations. Now, here you see we have our columns. Now, our first column, column A here, we have 50 random companies. These are just companies I picked off the top of my head. Some things you'll see look a little bit familiar. We got McDonald's, IBM, Pfizer, Ruger, Walmart, MasterCard, Nvidia. Just 50 random companies, but I try to get some big ones and some small ones. Our next column here, we have the revenue listed in millions. So for Apple, that's 215 billion as opposed to 215,000. Next, we have our retained earnings. That's how much we kept and retained instead of paying out in dividends. And just for fun, we have dividends per share also here. Now, this is for financial year 16. So we have financial year 16, and then we also have our stock prices for 2015 and 2016, so that way we have a jump in between them. Now, the reason we have all three of these is because a lot of these I'm basing off of our holding period yield. Now, to solve for our holding period yield, what I did here, going backwards, we have F, E, and D. FED right here. So what we did was we took our financial year 2016, we subtracted our beginning price of 114.71 in this case, or financial year 2015 number, and then we added in whatever dividends were paid out. And we divided all of that by our starting out price in 2015, and that ended up giving us our holding period yield for if you had bought it in 2016 and sold it in 2016. So Apple didn't do too great, Microsoft almost 20%, Cisco 10%. I'm going to let you go ahead and look along these numbers. Go ahead and feel free to pause it if you feel so inclined. Now, I decided to run several seemingly random correlations, and let's just see what we got. The first one I went ahead and did was we have our revenues as opposed to our holding period yield. Now the question here is, does a higher revenue lead to a higher holding period yield? So not just the higher selling price, but also the dividends that get paid out throughout the year. Our second is going to be our retained earnings versus our holding period yield. Now that's going to be of the amount we made and the amount we kept, not just paid out, but kept. Does that, or is it a good predictor of our holding period yield? Now the third one I did, if you're going down the line here and following along, kind of seeing my pattern, is our dividends per share. Now, our dividends per share is obviously what we paid out as opposed to retaining. So, this is kind of saying, does higher dividends paid out, or higher dividend payouts, lead to higher holding period yields? Now, some of these, this might be true, some of these might not be true. I don't know, it's going to be fun to see. I went ahead and did the correlations. Now, essentially all you do is you run the correlation function and you highlight your two columns, and it'll give you a percentage, either positive, negative, or zero if they're completely unrelated. Now, let's go ahead and scroll over a little bit here. Alright, now here's what we got. We have our revenue versus our holding period yield, our retained earnings versus our holding period yield, and our dividends per share versus it. Now, if you're looking at these numbers ahead of me a little bit here, you'll see that there's actually a negative correlation between our revenues and our holding period yield. Now, that means not only are they're a decent predictor, not too much. 20.1% or 21% isn't really too much to get excited about. However, there is a correlation there. So essentially, as revenues go up, holding periods actually go down. Now, that could be maybe higher expenses from getting those higher revenues, or maybe you got to pay out those investors more, you got a higher WACC, or your average cost of capital. But who knows? Through some kind of magic, though, spread over 50 companies, so I think that's a good enough little data set, we have a negative correlation. Now, our retained earnings versus our holding period yield, only a 4% correlation. Now, from negative 100 to positive 100, that is somewhere right there in the middle. I think it's safe to say that our 4% right here says you really can't use retained earnings to predict your holding period yield. Now, our last one, kind of on the opposite end of the spectrum, is our dividends per share versus our holding period yield. Now, essentially what this is saying with this correlation is that the higher the dividend payout, the higher the holding period yield. However, that only holds out at about 23%. So it doesn't quite say it, but at around 24-25%, I'd say that's pretty decent. Like, it's not anything where I would start investing in every single company that had a high dividend payout or just the highest dividend paying stocks. However, that does show that they tend to have, if they have higher dividends, they do tend to have that higher holding period yield. Now, is that because they're paying out more and they're not just relying on this stock price? Who knows? That's more than what this video is meant to say. But here's our correlations. Not quite, not at all, And maybe, who knows? Actually, let's go maybe for both of these, the first two. But that'll be it. Y'all have a good day and enjoy your finance holiday.